Hello, everyone, and welcome. And I hopefully you can hear me well enough. And we've got a lot to cover in still a short amount of time on everybody's Friday. So looking forward to moving this along and engaging everybody. As Joe has said, this is an interesting format. We're going to try to do this as a workshop, as if we were all sitting in the same place in the same room, and being able to kind of debate, but amongst that. And so the way we're going to approach this is we're going to break it into, as Joe said, we're going to break this into two sessions. The first one, we're going to ask 7 discussants to talk about several points. One is who they are, what they where the organizations they're with, kind of the mission of those organizations, and then what are some of the major issues they're pushing right now on the topic of small business finance in Africa, and what do they see as the challenges, opportunities. And again, as Joe said, this is part of a continuum of workshops that the GSG has been sponsoring. It's just being done in a very different way right now, where we're really looking to build momentum amongst multiple stakeholders to work together in different ways to solve common problems. So this is a step towards it and a different kind of process in doing it. As I said, we've got 7 discussants in the first part of this that will each give a framing for this. And then in the second session, we'll then break into these breakout rooms and actually get into dialogues around the different issues that surface in the first one. Encourage everybody, because of the number and the process, if there are any questions, ideas, thoughts, throw them right up on the chat room. We have a couple of facilitators that'll be helping us pull those points together so we can include them in the discussion as we go forward. The basic, I don't know, Joe, if we can put up here, I'm going to just do a real quick framing, and then we're going to get right into the introduction and the discussions. So as Joe said, the collaborative is working with the GSG on this topic of small business finance. And again, none of this is unknown to you all, but we just wanted to make sure we're all framing from the same place. So what we're talking about is getting capital to these small businesses that are quite often at the stage of moving from an informal to a formal business, where their staffings can range from 5 to 250. IFC has sometimes used the number up to 500. And where we principally focus on is this 20,000 to 2 million. The collaborative itself is a network of different stakeholders, and our principal focus is around expanding the appropriate amount of capital for small and growing businesses. So that is what we razor focus on. We take 3 approaches to it. One is to have these kinds of workshops and gatherings and bring people together, discuss them. Second is to do research, but the research is to do research towards action. And we've just done it, if you've seen that, and you can find it on our website, is a survey of fund managers and capital providers operating in sub-Saharan Africa and the challenges they're seeing for themselves and their portfolios post-COVID impact into Africa. And with that, it has now led us to do a third part of our mission, which is where we see gaps is to take on initiatives to fill them in. And right now, where we're looking at putting together a facility that would extend financing and capital to these local capital providers who then provide to their portfolios that are struggling, particularly with the working capital challenges in front of them. So those are the things that we focus on. And it's, again, on behalf of these organizations. And on the next slide, which again is very quick, is really, again, just why are we bothering? The numbers are massive. 330 billion in gap for small business financing in Africa alone. And then when we take it to a gender lens, which is a very important area for us, because we view ourselves as the voice of those that are most marginalized in getting capital to the right players. And what we have found in our survey, as an example, women-led funds in Africa, 90% of them do not break the 5 million in size. So they're having real trouble raising capital as a group of capital providers. So fundamentally, these are the kind of barriers we're trying to break through. And that's really what this discussion is going to be about. As I said, we've got 7 discussants. They break into 2 groups. One is those that are actually in the market doing local capital provision in different ways. And those that are looking at this both either from a more institutional perspective, either from a development agency, foundation, from government agencies, or even from the coordinating role of the national advisory boards of the GSG. And again, what we find really important about this whole dialogue and why we're excited about this, the GSG and the NABs bring a unique combination of the global and the GSG, all of those knowledge and resources, and the real issue of life is happening on the ground. It's in these markets, and the knowledge and the need to work through the local capital players and stakeholders, and hence the national advisory boards. So that merger of concepts, I think fundamentally was a great design for the GSG, and why this conversation is going to be framed around that. So what I'd like to do is, as I say, go around the room and ask the 7 discussants we have to introduce themselves and give a little background as to the issues and challenges and opportunities, and we'll pull that all together and use that as our framing for the second session. So if I could start with Evelyne up in Senegal, if you could introduce and go ahead, and then we'll move on from there.
Hi, Joe. Thanks for having me here. I'm really excited about the discussion we are about to have. So I'm the Managing Director of Wehbe Capital, which is a fund that exclusively targets women-led businesses in Senegal and Côte d'Ivoire. So the fund has been set up in 2019 by the Women Investment Club, which is a group of 86 Senegalese women who came together and joined forces to address the issues that women entrepreneurs face in terms of access to capital and also access to TA, technical assistance. So I will not come back on the gaps on the SME side, just highlight the fact that all you have said is words for women entrepreneurs. In Senegal, only 4% of them are financed by banks and microfinance institutions. And this is actually due to the fact that when you look at the entrepreneurs population, only 30% are women. And these women operate at a very small scale with revenue of less than 200,000 USD per year. And because of this small scale, they lack key resources to grow their businesses, like technology, access to the right skill set, like HR, also processes, organization. And because of that, they are not attractive enough for banks. They are too small for PE funds anyway, and they are too big for microfinance institutions. So we wanted to target this population of companies and provide them with the right financial tools, bringing capital, modern financial instruments, and also bringing technical assistance. So how do we do it? We bring equity and quasi-equity tickets ranging from 50,000 to 250,000 USD to early stage businesses. So for us, an early stage business is a company that has been operating for less than 5 years. And we put a lot of emphasis on the technical assistance side. We rely on our expertise. As I said, we are 86 women in Senegal with different backgrounds, different sectorial expertise that we at the fund level use during the due diligence. And also once we invest, we use this expertise in to help these businesses address their challenges, the challenges they face. We also just set up a technical assistance facility, the Wehbe Academy, that we focus on investment readiness for the companies that we have identified, but we also bring support to our portfolio companies. We are setting up a shared service center where our portfolio companies will find world-class accounting services, fiscal, legal services, and also services on marketing, market intelligence, communication, and whatever a company needs to grow and to unleash their potential. We are really happy to have closed this week actually our second investment in the fashion industry, in the local designer brands. We are going to bring to this brand the right organization for the production, but also the possibility to make our products available to online. We are going to develop an e-commerce with our investment, but also a distribution system to concept stores around the world. So the brand is already active, but was a little bit semi-informal. Even if we saw the potential, she was generating an interesting level of revenue. A few weeks ago, we announced the first investment in a local recycling plants as well. And yeah, we are really proud to see that things are moving forward on the pipeline side. The pipeline is really getting stronger. In 1 year, we have been in contact with 150 companies and have identified a strong 20 companies pool that are really strong candidates in Senegal, and we started sourcing deals also in Côte d'Ivoire. The main challenge we face though is still fundraising. Because we are a first-time fund manager, the issue has been raised several times during the last 2 days. The issue that these funds are not getting funding from DFIs. Even if DFIs are targeting SMEs, they want to reach these SMEs in Africa, but they don't have the right intermediaries with banks and PE funds. I hope that's something that we are going to discuss later. But first-time fund manager is not the only issue for us in terms of fundraising. The fact that we are a small fund also is an issue. We decided to raise 15 million USD for the 2 countries because we want to do small tickets. And because of that, we are kind of left out. So we are mobilizing local capital. We are trying at least. And we have some success though. We have a first loss tranche from USAID with the WGDP program. We have also first loss tranche from FMO that we hope will help us mobilize the capital we need to move forward next year. With COVID, of course, fundraising has been slower. And for us, it's really urgent to make sure that the companies that we target are getting capital because all relief measures are not reaching them. Government measures are insufficient. They are going to banks, and banks are focusing on their portfolio, of course, because these guarantees are only partial. Also, programs from foundations are also focused on guarantees. And for us, the issues on these businesses are bankability and investment readiness. So they were not in the pipeline in the portfolios of funds or banks. So setting up guarantees is not going to solve their problem. And these businesses need the capital now to grow and continue to support the jobs that they provide to the economy and contribute more to our GDP and to our growth. So I hope I'm in the right. I tried to do it really quick. So I hope I didn't.
It is a challenge, but thank you, Evelyne. And again, yes, we are moving quickly, but that is great. And congratulations on the closing of the transaction. And appreciate hearing some of the opportunities and the challenges of a angel network focusing on women entrepreneurs and women led businesses. So let me quickly now move to Chris Wehbe from Lendable to speak about their business model and their opportunities and challenges.
Great, thanks, Drew. So as Drew said, my name is Chris Wehbe and I'm the chairman of Lendable. We provide senior secured debt financing to businesses in frontier and emerging markets globally, but with a primary focus on Africa, and our largest office is in Nairobi. Specifically what we do is we work with what we call digitally enabled or fintech companies. And basically what that means is any firms that receive their payments electronically. And that's important because if they're electronic, that means that we have receivables data that we can track historically and in real time. Our business model is more or less based around this digital element. When we started the company, we wanted to help address the massive deficit in finance across the developing world by making private credit more investable for commercial investors. And we felt there were 2 impediments to doing this. The first is currency risk, which remains an issue, but to a decent extent can be mitigated by hedging. And the second was reliability of data. And that's not just at a company level, but also at a broader macro sector or country level, just to really understand what loss rates look like, what recoveries look like through a cycle. And our main observation was that with the advent of things like mobile money, digital payments had the potential to solve this issue. And so what we do is that we integrate with the CRM or loan management systems of potential borrowers. We then verify this data independently with their banks or mobile service providers. And with this, we're able to build up an accurate assessment of the performance of their business. And we retain this live through the life of the loan so we can see how things are progressing on a real-time basis. To date, we've ingested about 14 million individual loans, and we do this across 5 sectors. So firstly, asset finance and MSME finance, which we term as productive assets. Then payment platforms and marketplaces, which we see as support services that are important for the use of those assets. And then consumer finance, which we see as supporting broader financial inclusion. In terms of our priorities really are twofold. The first is to scale, just to continue to scale the amount of capital that we can draw from commercial investors to our clients. And the second is bringing down that cost of capital over time. And that's really proving out a track record and proving out this is a viable asset class. To date, we have around a 3-year track record, or just over a 3-year track record. We've returned north of 13% to investors on a net basis every year. And then I think also importantly, we were able to continue dispersing during COVID. I think that's down to the fact that we have this live data, so an ability to see how borrowers' businesses are performing, what is COVID resistant, what is not, where they need support, and where they need more capital to continue to provide to their underlying clients. In terms of our current initiatives, really what we're focused on is making our capital work better for our clients. And that's in 2 principal ways. The first one is that they can make their capital work better for them, work more effectively for them. And we're doing that by, as we build up knowledge of a client, extending their principal grace periods. So rather than have a loan that amortizes immediately, we can extend that up to 18 months for certain clients. And the second is trying to manage transaction costs. And I think this is something that is difficult often for our clients. We're the first institutional debt they've raised, or the first debt they've raised at all. And so the legal costs of setting up the appropriate structures, the appropriate documentation can be pretty high. And so the way we're trying to manage that is by having facilities that can grow with them over time. So they invest up front, but whether with us or with someone else, they can grow those facilities because they've got the right things in place, the right documentation, the right experience. In terms of areas of challenge or where we'd welcome additional resource, I think there's always an obvious one in terms of capital. I think generally the demand and supply for this form of investment is pretty good, but there are specific forms of capital that I still think can be very impactful. And that is, as Evelyne alluded to as well, first loss, clearly, which helps, I think, be very catalytic in terms of the investors we speak to. And then also local currency, investors that are willing to take local currency risk in the more pre-frontier space, where other instruments are not available, and often underlying investors are just not willing to take the risk. I think apart from that, I think we have this huge cohort of loan data and live understandings of what's going on in markets in terms of coincident data. And I think we're keen to work with others to try and get broader inferences. Obviously, we derive a lot of particularly pointed information on our underlying borrower and on our particular sectors, but I think there's much more that we can do with that, and keen to engage with others with that. In terms of how we can be helpful to others, I think it's principally really as a platform and a partner. So it's having that knowledge and resources in terms of understanding risk, and that's not only because of the data we have, but also in terms of broader financial risk and understanding legal environments and things like that, to be able to lend from very, very small scale in a scaled way.
Chris, that's great. Thank you very much. And I've been impressed to watch Lendable continue to expand its portfolio of financings using the data approach that many people talk about, but it has been a challenge to execute on. And you guys seem to be down that path really well. Love to now, another person very focused on digital, Owureku Asare of EcoBank will now give us an update of where he's coming from within their organization and into this whole space.
Hi, Owureku, I think you're muted. Could you turn on your microphone?
Okay.
Brilliant.
Thank you. Okay. So I'll give a quick background. My name is Owureku Asare. I lead digital solutions for EcoBank Group within the commercial banking business. So I'll take the opportunity to give a quick background about EcoBank. EcoBank is a Pan-African bank headquartered in Togo. Was established in 1985. We currently have 23 million customers across 33 geographies in Africa. We trade on 3 stock exchanges in Africa: Nigeria Stock Exchange, Ghana Stock Exchange, and then the Cote d'Ivoire Stock Exchange. In terms of assets, we have 24 billion in assets. and then with an equity of close to 2 billion. In terms of digital or footprint, we have close to 850 ATMs, 850 branches, and then close to 2,700 ATMs with 40,000 agency banking network. We currently have 15,000 workforce from 43 nationals. Our operating model is pretty simple. The business is modeled from the group across 3 business segments, corporate and investment banking, consumer banking, and then commercial banking that looks after SME. That's a great middle. That's where we see the potential. And then we operate in 3 clusters. So the UMWA, Nigeria is a cluster in Anglophone West Africa, and then Central, Eastern, and Southern Africa. I'll just go straight into the opportunities that we have and what we are trying to do to solve the problem for the African businesses. Currently, we have over 75% of retail transactions in Sub-Saharan Africa in cash. And a lot of the time, when you have conversations with them, they don't see the reason why they should go into digital. But the point is that cash is sterile. Cash will not add value to the business. So what we've been doing over the past period, our focus is to how do we then, because we all know that access to financing is a challenge because of informal structures, lack of collateral, and most of them don't even have any credit history. So they will tend to go to loan sharks, family and friends that usually is not reliable, and in some cases receive supplier credit. So our solution is to how do we then provide payments and digital solutions to increase data sources so that we all know that today data is a new oil, so that we can use data to understand the customer, understand very well their businesses, their cash flow, so that we can leverage on analytics to support their businesses. So what are we doing? We have our flagship product, EcoBank Pay, which is a QR solution running on Visa, MasterCard, and Pack Rails. So it makes it much easier for us to, because it's a QR solution, less just the paper cost that you can use to deploy. So every SME, micro or MSME can have our acceptance channel. Those that are the medium businesses can have our post or web channel, and those that still want to have cash or still receive cash from businesses have the opportunity to visit our agency banking points to be able to make this payment. What we then do is rely on these transaction data to then understand their cash flow needs and their ability to pay back, and try to give them that required support. In terms of increasing data points on the businesses, we've actually gone into a very strong partnership with Google to provide business tools to these entities to ensure that they'll be able to stand out on their own, because we know all that's happening within COVID. A lot of the businesses that didn't have online presence need to shut down, so that they can also have the opportunity to engage their customers remotely and have the insight that they require to be able to support their businesses. So this in a nutshell is what we are trying to do in terms of partnerships and what we need to do with others to get this to a next level. We are working with fintechs to be able to help us with our digital lending and all the tools that we need for the businesses. So thank you.
Owureku, thank you. And I was very impressed with the comment you made recently about the whole point of helping small businesses think of the value of transactions. And I think somewhat similar to what Chris was talking to about moving from cash to the digital and ways of monetizing that. And I look forward to really expanding on that discussion as we go into the next session. If I could now ask Takumba Ishmael of Alithea to give us her thoughts.
Thank you, Drew. So as Drew said, I'm Tokunboh Ishmael. I'm managing partner and co-founder of Alithea Capital. We are a firm that seeks to make investments that do a couple of things, primarily to enhance access to essential goods and services. And a key part of that is financial inclusion and energy inclusion. And another aspect of what we primarily drive is to invest in growth businesses where there's an impact on women. And we do that at a number of levels. First of all, we are seeking to leverage on the opportunity of plugging the funding gap of investment in female entrepreneurs, women-led enterprises. Drew showed that statistic at the beginning. There's over a 40 billion funding gap to female entrepreneurs and women-led businesses on the continent. And we see that as an opportunity. And so we seek to plug that gap by investing in women-led businesses. And for us, it's an opportunity because without the women, without the full team on the African continent, Africa can't reach its full potential. And so we can't be leaving behind half of the businesses. We believe it's good business, but smart business, but we also believe that it's the right thing to do. So really, so for us, access to essential services, financial inclusion, investing in growth SMEs for gender inclusion. But then also in terms of the women impact, we're also looking at, diverse teams. How do we channel our funding such that we also help to increase the move towards gender parity through diverse teams, gender diverse teams, through greater representation of women on boards, again, gender diverse boards, again, smart thing to do, effective decision making, better corporate governance, and for us, better products and services. How do we also ensure that the value chain of businesses are run in the right way as good businesses so that they can reach their potential? And a good business that's running in the right way thinks about the environment for all its employees, better environment for all its employees so that its employees can reach their potential, company can reach its potential, and a key thing for us, Africa, to reach its potential. So what do we see as the opportunities? I've mentioned one of them, that's plugging the gap on the lack of funding to women-led enterprises. We also see that by driving and enhancing access to essential services for the underserved, the marginalized, we are in a position to channel funding to improve products and services broadly. So lifting the bar on the nature of the products and services, better health, and we're health services. We've all seen how the crippling health infrastructure in Africa in particular has been exposed with COVID, lack of investments in those areas. So, and we feel that if we improve in sectors like health, education, particularly looking at improving that for the masses, the man on the street, everyday folk, that will raise the boat for the tide for everybody, and all boats will be raised. So that's where we see opportunities. In terms of the challenges, so for us, what we see with our funds and the money that we deploy, we see great pipeline. We've got a very robust pipeline, over $200 million worth of pipeline of small and growing businesses. Some of those are financial intermediaries that are also supporting micro enterprises. So we have a robust pipeline. But oftentimes we also find that with some of our businesses, some of the entrepreneurs have not had the adequate support for them to think about business planning.
And up until now, I think largely, not completely, but we have very limited.
business resilience planning, and really being able to scale. How can they think about scaling? A lot of time we see that businesses think that all they need is funding, but we all know it's not necessarily just funding, it's what you can do with the funding. So that business support, we bring some of that, but we find that there's a challenge in terms of companies being able to get to investment prepared and investment ready and plan for their scaling. So we would like to have discussions around that. And that's related to also post-COVID planning, the resources for that, because if your business is impacted, oftentimes we've already heard about some of the businesses now recognizing that they need to undergo digital transformation, but there's more than that as well. You know, how do I plan for my business to be resilient post this period and to even prepare for any repeat situations like this? Also, as an impact investor, we are typically looking for our enterprises to report on certain metrics of impact, and sometimes that can be voluminous for some companies. We'd like to see how we can think about some kind of support for firms to be able to understand better their impact, whether that's on the environment, socially, governance-wide, and be able to report on that better. So how can we give SMEs the right tools to be able to come to the table smartly and report on those metrics? And then finally, which is not unrelated to the COVID era, we're in African nations where the concept of support through schemes like the UK's furlough scheme is non-existent. So how can we create synthetic furlough schemes for some of these businesses? You know, there might be another instance of a lockdown. How do we think about the kinds of business support for those companies that's outside of them receiving investment, but enabling them to be more resilient and in some cases just be able to restart their companies? So we're seeing some of those challenges and would like to spend some time talking about that. So yeah, that's it from me. One last thing, what can we offer? Well, we, like I said, we have a robust pipeline, so we can offer access to some of that pipeline, especially where we're not able to meet the needs of those companies. We provide growth mentoring to our companies in terms of thinking about their growth and scaling. We also see that with some of our female-led enterprises, there's an issue of aspiration and helping them to think through that aspiration and growth to scale is an area that we can help. And finally, Alithea, IDF, the women, the fund, the Gender Smart Fund that we set up for women-led businesses, we've created a toolkit for how you can think about investing in women-led businesses, how you can analyze a business going into it and thinking about where it is along the scale of being gender inclusive and the aspects and the areas of the business that need to be looked at to provide tools to improve the diversity of the business so that that business can achieve better performance and sustainability. So I'll leave it at that for now.
Great, Takumba, thank you. And again, yes, lots of important things about how to accelerate and support the women-led businesses, and look forward to following up on that. We're a little tight on time, but we're going to continue pushing forward. Nicholas, if I can have Colloff of Argidius Foundation.
Thank you very much. Good to be here. Argidius is a private family foundation. We're based in Switzerland. We primarily focus on supporting effective business development services. So our first starting point has not been on the provision of finance, but on the provision of the non-financial support that businesses need to grow and develop. We've spent the last 6+ years working out what does a quality business development service look like, what are its characteristics in driving business revenue growth, their ability to create employment, and importantly, their ability to raise follow-on finance. And we've come up with a series of characteristics. Since we work in development, we've also come up with an acronym which we call SCALE. More details of that are on our website. Not enough time to get into that now, but it has distinctly changed both what we fund, but it's also distinctly changed the ability of the business development services we work with to achieve impact as they've taken on board the lesson of SCALE. But the second piece of our work is indeed to help enable better financial provision to small and growing businesses, and to tie that with providing better non-financial support services in order to de-risk the provision of those financial services. We've done that really in three principal ways. So one has been to work together with a collaborative Frontier Finance to begin to create a much better sort of taxonomy of what we're talking about. So people still tend to talk about small and medium enterprises as if they were just one huge lump. And to disaggregate those in terms of different kinds of businesses, with different kind of trajectories and different kinds of financing needs being provided by different providers. So we have a much richer understanding of what it is we're trying to do. We've supported the development of early stage investment funds in sub-Saharan Africa. So for example, we're working with INP to build locally owned early stage investment funds in 10 countries in sub-Saharan Africa. We're on Fund 6 at the moment. And there we've been basically accelerating their ability to develop those funds by providing seeding grant capital to enable them to do the work of establishing those funds. But also critically, we've been working with commercial banks in Kenya, now in Uganda, now also in Rwanda, to think about three things. So one is think about how to disaggregate their SME market, which they don't do very well. That's their terms for it, not mine. To improve their customer relationship management. So how do they not only better understand the market segment, but how do they actually recognize that the market segment sits in their own bank? And thirdly, to develop products which are cash flow based rather than collateral based in order to meet the differentiation of that market, which they have a better handle upon. So with one commercial bank, had 1 million MSME clients, was lending to them as MSME clients to only 6%. Because actually the vast majority of that 1 million were seen as private clients. So here is a commercial bank with a huge amount of data around over 1 million SME clients, but not recognizing it. And in being able to help them recognize it, enable them then to begin to roll out the new product effectively across their branches to a significantly higher proportion of their existing clients. So they weren't even actually having to find new clients or break into new markets. It was just understanding better the segmentation of the existing market and their ability to manage that data effectively and intelligently going forward. And finally, linking those commercial banks with providers of non-financial services, building up either their own provision or their relationship with external providers in order to both de-risk their own portfolios, but also obviously to advance the accessibility to that financing from the bank. And very finally, post-COVID, to actually begin to set up information portals. So we've done 2 now, one in Rwanda and one in Uganda, so that SME businesses can actually have access to what support is available, what they should do in relation to their loans, and so on and so forth. So information asymmetry between the small and medium enterprise and the opportunities for support has been a critical area in which we continue to work. The challenge is obviously manifold, but certainly one of the things that we can help with is both knowledge. We've now developed a significant amount of learning around all of the things I've just mentioned. We're a bit data obsessed, and so the learning is often driven by the data. And of course, as a funder, we're always looking for neat, smart opportunities to advance this work in sub-Saharan Africa.
Nicholas, thank you. Much appreciate the walk through all of the different development and, as you say, tackling the information asymmetry challenges that can come from where you all sit in the de-risking considerations that I think we're hearing a number of times. We are all running a few minutes behind. I don't think that surprises anybody. And frankly, each one of these speakers could go on with a lot more details. So appreciate your patience. We're going to just continue on. We've got two more of the discussants that I would love to hear from, and then we'll take a shorter break and then regroup for the second session. So Austin Mwape, if I could ask you to give us your perspective from Zambia.
Thank you very much, Drew, and thank you very much all for having me. It's really a pleasure to sit here and share some of the pertinent experiences generated by the current situations we are facing. In terms of what I do, I chair the National Advisory Board for Impact Investment in Zambia. I'm also the immediate past chairperson of Stanbic Bank Zambia as of last week. And my intention today is basically to try. We do a lot of things as a National Advisory Board, but there are certain things we do which are specific to SMEs, which I would like us to discuss. But before I do that, just to put into context what the National Advisory Board does, we are an affiliate to GSG, and in terms of our vision is that of achieving a prosperous Zambia driven by inclusive growth, inclusive green growth, and sustainable development. And our mission, which basically captures and contextualizes what we do, is to mobilize stakeholders and resources to support the creation of a private sector-driven impact economy through identification of domestic opportunities for change and innovation that help achieve and maintain SDGs. So, having said that, the business model in terms of how we function, we basically function as a platform. In other words, we do structure work streams and then crowd in resources, both human and financial. And the long-term view is that we will generate some income, some fee income and commissions from these activities. A good example is that the mapping we did last year is an event which basically was done as a platform activity. Coming back to SMEs, the COVID-19, of course, brought its own risks, and some of the interventions that have been put on the table are meant to address, amongst other things, the flow of capital to SMEs. An intervention which the central bank has put together, which they are calling a target and medium-term refinancing facility, is the major initiative I'll focus on today. The targeted medium-term refinancing facility, from the central bank's perspective, is an intervention which is supposed to mitigate a source of risk to financial system stability. So they are not just looking at SMEs, they're also looking at those institutions in the real sector to which banks and other financial institutions are exposed, because if they have challenges which compromises their existence, these problems will filter into the balance sheets, hence creating a source of risk to financial stability. So that's the context of the central bank's interest. But however, we do acknowledge that SMEs are also a part of the real sector, and we engage the central bank to say, look, the way the TMTRIF has been structured, it does not exclude SMEs, but at the same time, it does not explicitly mention them as targeted beneficiaries. Then two, for good reason, the central bank has basically pushed all the risk to financial service providers. The funds they are putting on the table are public funds, and they have a reasonable obligation to protect them. But what that means is that the financial institutions basically have no meaningful motivation to change the way they conduct business. So the chances of this money getting to where it is intended becomes compromised. So the central bank has acknowledged that reality and have said, okay, how do we intervene? And this is a discussion we had around April. And just to help contextualize the nature of the problem, because what has happened is that the activities between April and today are indicating that the fears we had are actually materializing. And I'll just walk you through quickly some of the numbers which we are getting in terms of how this targeted medium-term refinancing facilities is faring out. As of 3rd September, which is last week, 10.3 billion kwacha was applied for from the industry, 5.3 billion from non-bank financial institutions, 4.9 billion kwacha from banks, from commercial banks. Approvals, 5.4 billion kwacha. So of the 10.3 billion approved, only half of that has been, applied for, only half of that has been approved as advances. Banks approvals are 4.8 billion, 4.5 billion kwacha. Non-bank financial institutions, 895 million kwacha, making a total of 5.4 billion kwacha. In terms of disbursements, of the 5 billion, only 1.7 billion kwacha has been disbursed. And the channels, the commercial banks have had a major chunk of this, 1.5 billion kwacha. The non-bank financial institutions, 221 million kwacha. More importantly, in nominal terms, in terms of which, in nominal terms, in terms of beneficiaries, banks of the 1.5 billion kwacha, the beneficiaries are 250, of which 5 are households. For the non-bank financial institutions, of the 221 million kwacha, 13,398 are households, and yes, 13,398 are households. Now, what this shows, and this is basically about 92% of the number of beneficiaries from the 221 million kwacha disbursed by non-bank financial institutions. So the impact in terms of value is very little. Because of the 1.7 billion disbursed, only 221 million kwacha has been sprinkled about over 13,000 beneficiaries. And the majority of these are households. And we know that in Zambia, households are basically those people who borrow money based on salary, the payslip loans. So in terms of actually going to the SMEs, there is hardly anything going there. In fact, for manufacturing, only 8 beneficiaries are on record from the numbers I have. So it is quite clear that minus intervention, there is basically business as usual. The funds are there. We know the pathway we want in terms of the outcomes we want to achieve, but the transmission mechanism has got problems. And this is not a new problem. This is a problem which has been there through and through. So we have engaged, and the central bank has agreed to engage us to see how best we can structure de-risking interventions. And there are a number of things we are working with. We are talking to the pension funds to see whether we can release some of that money. The current laws allowed them to do so, and see what vehicles can be structured, such as credit guarantee schemes, etc. The credit guarantee scheme we have is undercapitalized, it has governance challenges, and no one is interested in putting money there. So we are looking at other options. So this is work in progress. There is traction being made. There are a variety of tools, but because of time, I won't go into the details of that. Right. Now, having said that, I can just now in conclusion.
Austin, I'm going to hold you a little bit on timing here. And we can pick it up as we go into the specific sessions. I apologize, but I'll just if you could wrap up in another minute, it'd be great.
Yes, I'm just wrapping up.
Thank you.
In terms of resource support or collaboration, I think for us, it's basically technical assistance. We are already working with GSG and Drew himself in structuring the de-risking interventions I'm talking about. And then in terms of what can we offer to others, I think the collaboration with the information banks, with the central bank, is innovative, and there will be lessons learned. It may not work, it might work, but at the same time, there will be lessons learned which others can leverage from. Thank you very much.
Austin, thank you. And there is a lot there to be built with, and I'm so glad this is part of the discussion, because this is probably one of the most real attempts of any country I've seen in trying to address the current COVID from the national level, and an open dialogue to say what's working and not working. And your numbers are pretty, I guess discouraging might be one word for it, but it's also revealing. And I guess it's another way of thinking about the information asymmetry that Nicholas spoke to before. We need to know these things and what's working and not working to build on. So, and I think you're right. What can be learned from this experience can be expanded, and hence why we want to incorporate into this discussion today. Charity Wallace from USDFC, well, the last of the speakers to speak, and we have extended past our break time. So Charity, don't feel constrained that you're keeping us from break. We're going to probably just take this straight into the next session as is. And I'm excited to hear from you because of the major institutional players. I think it's fair from where I sit to say that the USDFC has really been leaning in with COVID. So love to hear your thoughts and where we go from there.
Thank you so much. Good afternoon, everyone. I'm Charity Wallace, and I joined the U.S. International Development Finance Corporation in March as their managing director for global women's issues. And we refer to that as 2X because of the multiplier effect that investing in women produces, which has been discussed somewhat today. So the DFC, which is formerly the Overseas Private Investment Corporation, is really the U.S. government's development finance bank. I'm sure most of you know that. And we partner with the private sector to bring economic prosperity and stability to emerging markets around the world. So I'll talk a little bit about what we're doing and then some of the opportunities for collaboration, which is something that I'm really passionate about. So we have projects in over 100 countries, where we aim to infuse private sector solutions into some of the world's largest developmental challenges. So DFC is a sustainable form of development. That's how we think of ourselves because of the way in which we invest. We invest in commercial projects to drive economic growth in emerging markets. Our portfolio really spreads across a range of industries. So that includes infrastructure, financial services, and we invest in a lot of financial intermediaries, which is where we reach the most SMEs. We also invest in agriculture, healthcare, energy, and education. And it's interesting because when OPIC transitioned to DFC, we were able to obtain additional products and tools, financial products. So those include now equity for the very first time. And in our last board meeting on Tuesday, we actually deployed equity to 2 companies in Africa that are supporting women, which is really exciting. We also continue to have our debt financing available, political risk insurance, and then technical development assistance has actually been added to the DFC. So it's a new product that we offer at the DFC. And what we're really looking to do is lead private sector capital where it otherwise wouldn't go in order to achieve better development outcomes and economic prosperity. But the way that we feel is we know that to achieve those goals, we can't do that unless we empower women, which is why we have such a strong emphasis on women. It's been described by a couple of our colleagues on the panels today, and we really feel like arguably the biggest missed market opportunity is that of women. So just to give really brief data points, McKinsey Global Institute found that eliminating gender disparities in employment, sector, wages, and credit would add an additional 12 to $28 trillion to the global GDP by 2025. And I know I've seen in the chat, we talked a little bit about the shortfalls that women have with regards to access to credit. So, you know, women represent an immense global opportunity, but they still face persistent challenges. So for me, I think of this as one of the opportunities that we offer at the DFC, which is to apply that gender lens to our investment strategy. So there's a roughly $300 billion shortfall in access to credit globally, and that prevents women from reaching their full potential. It also prevents countries from and communities from reaching their full ability to be prosperous and stable. And so that's one of the reasons why supporting women's economic empowerment is part of DFC's very core missions. So we launched 2X in 2018 with the commitment to mobilize $1 billion in 5 years towards gender smart investments. They surpassed that within the first year by applying intentionality around gender smart investments. And we brought that same intentionality to the continent of Africa with our commitment to what we call 2X Africa, which is a commitment to mobilize and catalyze $1 billion towards commitment towards investing in women-owned companies or women-led or women-supporting companies. So to date, we've closed over 95 2X deals with over 115 in our pipeline, and more than 50 of those are 2X deals in Africa. So again, it lends itself to the opportunity that we provide as the DFC is coming alongside, bringing along private sector partners to enhance what we're doing as it relates to empowering women on the continent. We're also through the DFC, really investing in Africa through Connect Africa, which has to do with infrastructure, Prosper Africa, which has to do with trade. And then we also recently launched something called the Africa Investment Advisory Program. And that establishes a regional team. It's our very first regional team at the DFC. There's 5 new, what we call AIA leaders. And so they'll expand our portfolio with a priority as a priority region for the DFC. And that will actually help us respond both to the health and economic fallout from the COVID-19 pandemic. So that's something that we're really working on with that new group that we've added. We're actually supporting women-owned, led, and supporting SMEs through our investments, like I said, through financial intermediaries. We're supporting female farmers through our transactions, and I'd love to talk about some of those transactions later. And then we launched something called Maternal Outcomes Matters, and we call that the Moms Initiative. And that really aims to mobilize private sector capital to support maternal and child health in sub-Saharan Africa. And so that's a partnership with DFC, Merck for Mothers, Credit Suisse, and USAID. And I'm just giving that as an example because it is a way in which we're investing in companies that will then help decrease maternal death and ensure healthy pregnancies and safe deliveries. It's one of the examples that we've used to look at our COVID response, as well as a global nutrition alliance that we just announced last month that we'd love to identify new partners for. So that's an opportunity for us to, in an area of collaboration. We're also really focused from the 2X perspective on closing the digital divide, especially for women. So with regards to thinking about areas of collaboration, I think of those 2 in particular, identifying new pipeline, and then really we're trying to focus on more investing locally owned or locally led companies, funds, and the like. So again, we're leveraging private sector solutions, creating collaborations, and from my perspective, continuing to promote and advance women's economic opportunity and empowerment on the continent of Africa. So I'll close with that and looking forward to the next discussion.
Great, thank you, Charity. And there is a lot to talk about from what you DFC has been doing, and
Right.
it's hard to take the largest development, one of the largest development agencies, and do it in a few minutes. So thank you, but really, and very, very great successes with the 2X challenge, which is exactly
what we need to be seeing.